Welcome back to the Deep Dive. Today we are doing a really focused analysis. We're drilling down into the latest earnings call from Saratoga Investment Corp. That's ticker SAR.
That's right. We're looking at their fiscal third quarter for 2026, which is the period that ended back on November 30th, 2025.
And for anyone who follows BDCs, business development companies, this whole sector is, well, it's incredibly sensitive right now.
It's all about interest rates and credit quality.
So our mission today is to cut through all the noise in that call and really find out how SAR is navigating this pretty complex environment.
Let's do it.
The market certainly had an opinion right away. The stock was up about 1.5% on the day of the call. So, a pretty constructive feeling. Let's jump into the numbers that caused that.
Yeah, and the beat was it was pretty significant, especially on the GAAP side of things.
Okay.
GAAP earnings per share, it came in at 74 cents. The consensus was looking for 59 cents.
Wow, that's a huge surprise, over 25%.
It's a massive beat, a huge quantum leap over what everyone was expecting.
But the number that really, it powers the engine is net investment income, the NII. That's what colors the dividend. How did that look?
So adjusted NIR per share was 61 cents, which just topped the 59-cent consensus.
So a more modest beat there.
A more modest beat on a per share basis, yes. But the underlying engine, as you put it, was strong. The actual adjusted NII grew almost 8% from the last quarter.
To what, about 9.8 million?
Exactly. And the total revenue or total investment income, it basically followed suit. Just a slight beat there.
So the overall picture is a solid beat, backed by that sequential NII growth.
Right. And management, they really anchored the story on their strong credit quality and being able to sustain that dividend. But to really get why the market liked it, we have to look under the hood.
At the foundation, you mean?
Exactly. At their portfolio health.
Okay, let's unpack that.
Yeah.
In the BDC world, you live and die by your loan book. What are the metrics telling us?
Well, this is where SAR really stands out. It's what justifies that positive reaction. Their net asset value, their NAV, is about $413 million.
Which comes out to $25.59 a share.
Right. But the real headline, the thing that makes them different, is their non-accrual rate.
Okay, so for our listeners, that's the percentage of loans that aren't making payments.
Precisely.
Yeah.
And they have only one.
Just one.
One single investment on non-accrual. It represents a tiny, minuscule 0.2% of the portfolio's fair value.
Okay, you have to put that number in context for us. How does that compare to everyone else?
The staggering difference. The BDC industry average non-accrual rate right now is 3.2% of cost.
Wow. So SAR is what? More than 10 times cleaner than the average BDC out there?
It signals absolute discipline in their underwriting. It tells you that while the average BDC is juggling, 3 or 4 problem loans out of 100, SAR is barely dealing with one.
And that defensive posture, it's baked into the portfolio structure too, right?
Absolutely. Almost 84% of their investments are in first lien debt. They're at the top of the capital stack, the safest place to be.
Okay, so a rock-solid foundation. Let's pivot to how they're putting that money to work. What's the flow of capital look like?
Well, they are putting it to work, but I'd say modestly. Originations were about $72 million.
Which includes new companies and follow-on investments.
Right, and that did outpace repayments of around $55 million. So you got net portfolio growth of about $17 million.
$17 million it's decent. It shows they're still compounding. But is that fast enough given some of the headwinds we know they're facing on yield?
And that is the critical question. That's the challenge. Because while they're originating new loans, they're also facing some serious yield compression.
Meaning the interest rates on their loans are falling?
Exactly.
Yeah.
The weighted average rate on their portfolio dropped from 11.3% last quarter down to 10.6% this quarter.
That's a 70 basis point drop. That's fast. Is that just the market or something else going on?
It's a mix. Management pointed to, SOFR rates resetting lower, but also just intense competition leading to tighter spreads on new loans.
So their old, higher-paying loans are getting paid back.
And the new loans they're writing to replace them are at lower rates because the market is so competitive.
Okay, so that makes protecting that NII per share a real operational fight for them.
It really is.
Yeah.
And they said as much on the call. That 61-cent NII figure directly reflects that pressure from falling rates and high repayments. The engine's running, but the fuel isn't as rich as it used to be.
All right, so let's talk offense. We've established they're rock solid on defense. But the real story here, what gives them all this strategic optionality, is their dry powder.
This is where it gets really interesting.
How are they positioned to grow?
Their flexibility is just immense. They ended the quarter with an incredible amount of investment capacity. We're talking $396 million.
$396 million. Just to give everyone a sense of scale, that's enough for them to grow their total assets by another 39%.
Without needing a dime of external financing.
How is that broken down? Is it all cash?
It's a mix. There's about $70 million in cash on hand, but the real secret weapon here is the $136 million they have available through their new SBC3 license.
Okay, let's pause on that. For listeners who don't follow BDCs every day, explain why an SBE license is such a big deal.
It is absolutely crucial. The Small Business Investment Company, the SBACE program, it gives them access to very low-cost, government-backed leverage.
Cheaper debt, basically.
Much cheaper. It's like high-octane fuel for their returns. It's highly accretive to their future NII, and a massive, massive competitive advantage.
So they're not just playing offense with that. They're using that balance sheet strength for defense too, right?
Oh, absolutely.
Yeah.
They just refinanced a $65 million credit facility. They upsized it to $85 million.
And the key part.
They cut the interest rate spread by about 150 basis points and pushed out the maturity date. That's just smart, proactive management of their own costs.
But there's always a clock ticking on something. What's the next big decision they have to make?
The big one is a $175 million note that's maturing at the end of February 2026. It's got a great rate, 4.375%.
And replacing that in today's market will be more expensive.
Almost certainly. So they've got to decide soon how to deal with that. Use their cash pile or go out to the capital markets.
So that $396 million isn't just for offense, it's also the solution to that looming maturity problem.
It's their ultimate safety net. And they have another lever too. They can call $269 million of their existing debt, which is costing them over 6% right now.
So if rates keep falling, they can cut their own interest costs even further.
Exactly. More optionality.
So with all that capital, what's their deployment strategy? We know the M&A market is picking up, but it's competitive.
They're doubling down on what's always worked for them, the lower middle market.
Smaller deals.
Smaller deals. But, as they put it, better deals. They can do much deeper due diligence, they get more conservative structures with less debt, and they get stronger protections or covenants.
So they're deliberately avoiding the big, crowded, covenant-late deals you see in the larger market.
100%. They are prioritizing risk-adjusted returns, not just chasing volume. And it's paying off. 5 of their last 7 new investments came from completely new relationships.
Which is key for building a sustainable pipeline for the future.
Exactly. It's organic growth.
Okay, let's connect all this back to the thing investors care most about, the dividend.
Right. And they maintained it. Declared 75 cents of the quarter, paid out as 25 cents a month. And you have to remember, they also just paid a 25-cent special dividend in December.
That special dividend, that really signals confidence, doesn't it? Especially with those rate headwinds we talked about.
It shows huge confidence. And it's earned. You have to look at their track record.
Yeah.
Since this management team took over in 2010, the total return has been 851%.
Wow. And what did the BDC index do over that time?
Just 283%.
So a massive, massive outperformance over the long term. And it's holding up recently, too.
It is. Over just the last 12 months, SAR's total return was a positive 11%. The BDC index, it was negative 4%.
The takeaway is pretty clear. That underwriting discipline translates directly into better returns for shareholders.
That's the story.
Okay. This brings us to the part of the show where we look at the potential optionality here and frame a trade idea. And as always, this is just an analysis of the facts we've laid out. It is not financial advice.
Right. In this trade, it really hinges on that balance sheet optionality we've been talking about, set against the sort of general weakness in the broader BDC space.
You've got that $396 million in capital, the ability to grow 39%, and the option to call all that expensive debt.
The pitch, then, is a BDC pair trade. It's based entirely on superior optionality and betting on superior execution.
Okay, lay it out for us.
First, you go long SAR. You're betting on management to use those levers. You're betting they'll call the high-cost debt to protect their margins while they selectively deploy that cheap SBIC capital into those great lower middle market deals.
All while keeping that non-accrual rate near zero.
Exactly.
Yeah.
But to isolate that bet on SAR's management, you need a hedge.
So you short the sector.
You short BIZB, which is the BDC sector ETF. It's been weak. It's down over the last month and the last year. This short position means the trade only really works if SAR's execution allows it to significantly outperform the rest of the struggling sector.
So it's a pure bet on their discipline and their ability to convert all that potential into actual income.
It's a bet that they can act faster and smarter than their peers. It all comes down to execution.
Fascinating. So to recap the core story one last time, Saratoga delivered the beat, proved its underwriting is best in class, and continues its long history of outperformance.
And here's the final provocative thought for you to chew on. Management said on the call that they see these tight spreads as, quote, more of a temporary thing. They suggested that as interest rates continue to fall, deal spreads might actually widen again, creating a really profitable environment for them to lend in.
So the big question is,
given that massive $396 million war chest, how quickly can they actually monetize that potential spread widening before that big $175 million debt maturity in February 2026 forces their hand?
it's a race to turn that optionality into income. The clock is definitely ticking.
It is. And it's what really makes them stand out in this very volatile private credit world.
Food for thought. Thank you for joining us for this deep dive into the Saratoga Investment Corp earnings call. We'll catch you next time.